How do you guys
Yep.
decide what's a deal, and how do you guys underwrite assumptions like expenses and vacancy?
We don't want to spend more than $2,500 to $3,000 on a property once we close on it to get it to inspection ready level. Every day it takes you to find that tenant means that property is vacant, which means you're not making money on it, but you're spending money on it. What happens when they move out and you have to turn that unit? It's going to be vacant when you turn it, and when you market for a new tenant, and when you have to place a new tenant, even if you're proactive about marketing ahead of time. And so those things all matter. I mean, so we factor in pretty much an 8% vacancy, an 8% maintenance reserve into every underwriting report that we do. And our buy box is very, very simple. It's $85,000 to $105,000. It needs to be a 3-bedroom single family home or more in a market that we can get at least $1,350 to $1,400 in rent on, so that we can cash flow on average about $600 net per door per month after debt and everything. One of the best things I feel with the affordable housing portfolio we have is we love to help single moms. And those are the tenants that always end up being so thankful. You're giving them a house to live in, and we're taking care of it. We take care of them just like we take care of a multifamily, right? We make sure that we're quick on our maintenance requests anytime something comes in. You know, if you do that, your tenants that you provide a home for are going to be so thankful, and they're going to take care of the property. The majority of landlords that own properties that put them into this program don't know what they're doing. They think because it's low income housing, they have to charge a low amount of rent. They think the housing authority does the background check and everything on them. And so they don't even do any background checks, no credit checks, nothing. And they ultimately end up getting a bad tenant. If you don't do your due diligence, you can get bad tenants in any asset class. You can get bad tenants in a Class A luxury property. You can get bad tenants in a Class B multifamily. It's not a lot of that if you make sure that you're doing a full background check, you're doing a full credit check, you do a full eviction check, and you make sure you're collecting a full month security deposit the tenant has to pay for out of their own pocket.
How do you keep everybody motivated and incentivized?
Doesn't matter what position they're in. I like to incentivize them with ways that they can increase their income by hitting certain things. And so like with property management, we have occupancy rate bonus levels. Once they hit certain occupancy rates, we have cash flow bonuses, meaning if for every property that they get cash flowing in 30 days or less, they get a flat bonus. Project management is part of that as well, because the property is ready to go and be inspected. And so they have a bonus for passing inspection on the first inspection. Acquisitions has a bonus based off of the number of properties that we actually close on every single month. Investor relations has bonuses based off of the amount of dollars they raise and exceeding the goals that are set. And so everyone is incentivized money-wise. The other way is it's a very loose kind of working environment. We like to joke around. We do team building, retreats where I'll take them out to like Top Golf, and I'll take them to dinner, letting them know that you appreciate their hard work. And so just a good, fun working environment is really important as well.
Okay, welcome to another episode of Affordable Housing and Real Estate Investing. Today, guys, I am so excited to share a different strategy when it comes to affordable housing. As y'all of you know, we've brought on folks from single-family investors to multifamily apartment syndicators and also ground-up construction developers. But today, we got a guy. He is the CEO and founder of Sim Capital with over 400 million of assets and almost 4,000 units under management. Wild, astronomical numbers. And I'm so impressed by this guy, and they have a huge focus on affordable housing. So I'm really excited to bring this guy on. Matt, welcome to the show, man. How you doing today?
Ken, thanks for having me on, man. I'm pumped. And I love the introduction. That's a good introduction, man. Thank you. Appreciate it.
Well, Matt, I know you as a fund manager, and you had a really interesting story to your real estate journey. Maybe let's just start there. Like, tell us a little bit about yourself. How did you even get into real estate investing in the first place?
So my real estate investing career or endeavor started back in 2006. I had actually sold another business that I was a partner in and just started buying real estate for myself and my family at that time, investing. And it was still kind of it was a side hustle for me at that point. All the way through basically 2014, it was still a side hustle, and I was building other companies. And 2014 came, I had some life-altering changes that happened. I was involved in a really bad accident. I was laid up for a period of time, ended up having to I went out of business in one of my businesses because I was laid up for about a year and a half. I broke my back and my pelvis. I mean, I was on bed rest for like 6 months. And I lost the one business that I had grown because I thought I had it structured really, really well, but I didn't have it structured to operate when I wasn't there. And so things just kind of started spiraling because I was basically on bed rest and laid up and recuperating. But it was the real estate portfolio that I had built that really got my family and I through that hard time. And so for me, it kind of made sense, like the light bulb. It was that light bulb moment in 2013, and I went, real estate saved me. Let's go all in and really make this the career and build the business around that. And so that's when I started Sim Capital. It was in 2014. And I had about 300 doors of real estate at that time, mixed of small multifamily and single family. And we originally started off as just a multifamily firm. And we were, and I structured it as a fund. I mean, we were structured from day one as a fund where initially it was just kind of like friends and family. And then that grew. And through 2021, we were still primarily a multifamily company. We focused on heavy value add Class B and C plus multifamily. However, the pandemic, as we all know, threw a big wrench in our operations when it came to multifamily with the rent moratoriums and eviction moratoriums that were put into place, and the big government basically saying, well, your tenants don't have to pay rent, but you still have to pay your mortgage and you can't evict them. And we all suffered during all that, right? I mean, I'm sure you saw it, we saw it. And it was another light bulb moment for me kind of coming out of the pandemic because I wanted our growth to continue, but interest rates were starting to climb. Multifamily deal flow dried up by like 90+%. There was just this massive gap between cap rate and debt costs, and sellers weren't realistic. But I also wanted to find a hedge against another eviction and rent moratorium ever coming back into place, right? And so I kind of went back to my roots because I started investing initially back in 2006 in affordable housing. And I said, well, if the government is going to basically screw us on the one side of things, let's take as much money from them on the other side of things as we can while providing housing to an asset class that really, really needs more houses in the program. And that's kind of where our pivot came to affordable housing in 21, 22, and has allowed us to continue our growth while everyone else is kind of just sitting there twiddling their thumbs in the multifamily space. And it's allowed us to continue our growth where you haven't seen a ton of growth from a fund standpoint, a private equity group standpoint in the last few years.
Wow, what a story. And I want to really highlight a few things. You talked about how you were kind of down and out, but then you realized that real estate is the thing that kind of saved your family or got it through some of the tough times. And I think that's such a crucial point that almost everyone getting into real estate nowadays, that's what they're looking for. They're looking for the crux, like, hey, what if something happens to me?
Safety net.
Make sure my family has a freedom. Exactly.
Yeah.
And I love how you came back and also quickly realized, like, hey, during the pandemic, when people weren't paying rents, how do we hedge against that? Like, because that's a great example of a great investor. Because you learn from that issue and you're like, how do I protect myself against that again? Versus
there's a problem.
Nothing.
Yeah. And so the way I look at it is like, I'm a business person, right? And any good business person, anytime they're presented with a problem, or let's face it, we are problem solvers, right? That's all we do basically on a daily basis as a business owner is we're problem solvers. That's all we do. Anytime I'm presented with a problem, I'm always looking for solutions. Right. And I wasn't willing to just sit back and be like, well, we'll just wait it out, whatever it is. I wanted to look at opportunities for us to continue our growth. And it sounds so bad, but in any bad situation, there's always opportunity. And you just have to be able to kind of step back, take a look at it from a different point of view and see where that opportunity is and then take advantage of it. And that's what most people don't do. And that's why most people aren't business owners or aren't truly successful. The ones that are truly successful are the ones that are able to identify the problems, find the opportunity in those problems, and keep growing.
Yes, I love this. Well, your investment journey brought you from affordable housing to multifamily and now also doing both at the same time. Let me just set the stage a little bit. Can you just share a story of someone you or your fund has been able to help through affordable housing? Do you have any good stories like that you can share with the audience?
So we have tons. I mean, one of the best things I feel that with the affordable housing portfolio we have and the size of it that it is and it's growing to be is we love to help single moms, right? We see a lot of single moms as tenants. Single moms with a couple kids, they're having a hard time, but they need a good roof over their head. And those are the tenants that always end up being so thankful that you're giving them a house to live in and we're taking care of it. We take care of them just like we take care of a multifamily, right? We're not a slumlord. We're not doing the bare minimum just to pass inspection. We're putting in, you know, good quality materials. We're keeping the property up. We make sure that we're quick on our maintenance requests anytime something comes in. And, you know, if you do that, your tenants that you provide a home for are going to be so thankful, and they're going to take care of the property because of that. Now, don't get me wrong. You always have those tenants that, you know, look like they're a good tenant or a good fit, and then ultimately aren't. But the number of single moms, and I would say a lot of our portfolio is rented to single moms. Those tenants are just so thankful because a lot of times they've been looking for a home, they've been looking for a property, and they can't find one, or they're competing with other people for that same property. And the need that is out there right now for more homes in the program is astronomical. And so, you know, it's not a specific story, but I think overall that the single mom with a couple of kids is just someone I really like helping out, because I'm a single dad myself. I have 2 kids, right? And so it kind of hits home with me.
Wow, I love that. And I think for people right now, sometimes people would say like, "Hey, go pursue what your passions are." And sometimes we hear this a lot, quite often. Some people would just say, "Oh, I just want to help people. I really want to help people."
Yeah.
Well, in this scenario is a great example of who do you want to help and how do you want to help them. In this case, Matt, you have found someone or a general avatar, single moms in this scenario,
Yeah.
that your company has been able to cater to because you understand the difficulty and you've been able to help them through housing, which is one of the most important things in someone's life.
Yeah.
It's
Yeah.
literally defined. Yeah.
So there's a saying that I didn't coin it. Actually, one of our investors coined it. He's now become a good friend of mine. He goes, "Matt, you're doing good while doing good." Meaning I'm doing good and helping others out, but financially we're also doing good because it's a very lucrative asset class if you do it right. That's the key. You have to do it right and know the ins and outs of it, but it's very lucrative. So you're doing good while doing good. And I've always loved that saying.
Oh, that's so good. I've heard that one before, and it's just so reflective of what we're doing in affordable housing.
Yeah.
Maybe if you can shed some light on, you just said, "Hey, doing good while doing good." Can you help dispel some of the myths associated with affordable housing? Because sometimes when I talk about affordable housing, people just think it's like guns,
Yeah.
drugs, drama
Yeah.
in the hood and the
Yeah.
project.
Yeah.
Help us
Yeah.
dispel that myth a little bit based on your experience.
Well, so I think that's just an uneducated opinion that people form based off of hearing it from a third party who heard it from a third party who maybe, you know, talked with someone that had experience. So let's be honest, the majority of landlords that own properties that put them into this program don't know what they're doing. You know, they own 2, 3, 4 properties, maybe 5 properties. They think because it's low income housing, they have to charge a low amount of rent. They don't have to collect a security deposit. They think the housing authority does the background check and everything on them. And so they don't even do any background checks, no credit checks, no eviction checks, nothing. And they ultimately end up getting a bad tenant. And that's where that myth comes from. But you can get bad tenants in any asset class. You can get bad tenants in a class A luxury property. You can get bad tenants in a class B multifamily. You can get bad tenants in a 5,000 square foot, $6,500 a month, you know, single family home. If you don't do your due diligence, you can get a bad tenant. And so it's not a lot of that. If you make sure that you are underwriting your tenants properly, you're placing the right tenants, and you're making sure that there's buy-in from the tenant side when they move into that property, meaning you make sure that you're doing a full background check. You make sure you're doing a full credit check. You make sure you do a full eviction check. And you make sure you're collecting a full month security deposit that tenant has to pay for out of their own pocket. Because if they have to come up with $1,300, $1,400, $1,500 themselves out of their own pocket to put down, I can guarantee you they're a lot more likely to keep that property in really, really good condition, because that $1,500 to them means a lot when they get it back down the road when they decide to move out and move on their journey. And so doing those things, you can place really good tenants that maintain the property like it's their own. You'll never have issues with them. You won't even hear from them. And as I always like to say, if you don't know the name of your tenants, you're doing really good, because that means you don't have any issues.
I love that saying. That makes such great sense in terms of getting your fundamentals right. Make sure you screen your tenants, and I love how you went into that process a little bit. Maybe we'll cover that even in more detail around there, because I want to hear about some of the tricks maybe, or pro tips that you might have to the audience for screening tenants, that would be really good. But I love
Yeah.
that we just set the stage for
Yep.
why affordable housing. Help educate the audience a little bit. Like, why did you decide to start a fund instead of just saying,
Yeah.
hey, sometimes what we hear people on the streets doing is, hey, I like you and I like you. Why don't we all two or three of us get together and start an LLC and just buy a couple of properties? Help us understand, well, why did you pursue the fund strategy and why is it more advantageous than some of the other strategies that might be out there?
So for me, from the fund standpoint of things, I wanted to be able to scale and scale big. And for me, on my side of things, the fund strategy and business model allows me to do that. The other thing that it allows for is that, look, most people understand real estate's a good investment, but most people, for a couple of different reasons, don't want to actually do it themselves, meaning they don't want to be the ones that have to raise the money. They don't want to be the ones that have to go find the property. They don't want to have to be the ones that has to place the debt on it. They don't want to be the ones that then have to market it and find a tenant. They don't want to be the ones that have to manage the tenant. They just don't want to be hands-on like that because either they have a full-time job and that's their active income, and to do that would also be another full-time job, or they just don't want to have to be hands-on like that all the time. And so they know that they want to invest in real estate. They know it's a good opportunity, but they want to be more passive and hands-off. And the fund structure like we have gives them the opportunity to be able to do that. They can invest in real estate. They're an equity partner, a limited equity partner, which means they get to take advantage of not only the income, but also the tax benefits, depreciation, write-offs, etc. And so you get the benefits of investing in the real estate, but without having to actually manage it on a day-to-day basis. That's what we do. We not only invest in real estate, but we also manage it. And so we're very vertically oriented where we own a property management group, and that property management group manages the majority of all of our properties. It allows us to control costs a lot better. It allows us to be a lot more reactive. We can react quicker to maintenance requests, issues that a tenant might have, because it's all vertically oriented here in our corporate headquarters. And it just allows us to be a lot more hands-on and get things done properly. And so from an investor standpoint, that's the big advantage that they get, is they can invest in the real estate, get all the benefits of it, but without actually having to be the one managing on day to day.
Man, that is such a great explanation. And more importantly, I think sometimes when I hear people talk about, I want to get into real estate, people say, I can't want to quit my job and get into real estate. And they end up just doing wholesale, which is just another job. It's
an active job. Wheel. Yeah, that's all it is. It's a 24/7 active income job. And it's not even investing because you're not buying real estate. You're not putting your money into something that is going to generate you income every day. If you're not working, if you're not actively trying to find deals and then shop those deals to end buyers, you're not making money. And you're not actually owning real estate. You're not buying anything. So to me, it's not even a form of real estate investing. It's a real estate strategy.
Completely agree with you, man. And if you want to invest passively, investing in a fund, that is really how you truly become passive, because you don't have to look for the deals. You don't have to make sure the contractor isn't running off with your money. You don't have to apply for loans. All that stuff that you just mentioned, Matt, that gives investors the true passive, that financial freedom that they're looking for, while they can continue making as much money as possible and the active income through their full-time jobs. I love
100%.
that.
We have some large investors that have invested 7 figures into our fund, specifically in affordable housing as well as multifamily, and they simply get a direct deposit every single month. In our affordable housing, it's 10% a year that they get every year, every month they get a direct deposit. We've been averaging 17% cash on cash over the last 2 years to our investors in affordable housing. I mean, someone invests $100,000, they're getting 17 grand back a year. I mean, for doing nothing.
And no work. Exactly.
Right, exactly.
Well, they had to do the due diligence on you, right?
Do the due diligence. Right. Yeah, but it's a one-time thing, right? It's not like every day they have to go back and handle maintenance requests, schedule contractors, advertise the property to get a tenant, screen a tenant. They don't have to do any of that.
Yeah. And I think this is the interesting part for the audience right now that's listening to you, Matt, and saying, hey, wow, what Matt's doing is really cool. And he gets to help so many people right now through this fund strategy. But I know personally, it's very hard to scale a single family portfolio.
Oh, it is.
From your perspective, what was the hardest thing about scaling this? And I don't know, any lessons learned that you might think like, hey, maybe I should have done that a little bit earlier?
Yeah, I mean, so scaling a single family portfolio or even a small multifamily with duplexes, triplexes, fourplexes, even sixplexes or eightplexes, it's hard because you have to buy a lot. right? And the biggest issue that we've had isn't buying. We have the funds to buy anything that we can get our hands on. It's the lack of inventory on the market. And there's been a lot of lack of inventory. I mean, we know we've been in a supply and demand market for how many years now, and we're in a supply crunch because there's not nearly enough houses to meet the demand, even with interest rates where they're at now. And so that hinders the growth, or that slows the growth. We don't tend to like to buy large portfolios of single families. We've underwritten some. We've looked at a couple 200 door portfolios for this fund, and a couple 100 door portfolios. But what we have found with most of those portfolios is you're buying 70 to 75% junk with 25% good properties. And if the ratios were flipped, okay, I'm fine. I can write off 25%, and throw some money at them to upgrade the units and rent them out and get them occupied. But what we have found is that most of the time those portfolios are just not good portfolios. The rents are very low. The properties are in really bad condition because the owners, the investors, aren't taking care of the properties the way that they should. And so that's been the biggest hindrance when it came to our scaling of this portfolio. Because ideally, when we want to get this to about 1,000 doors, we're a little over 600 right now in this specific portfolio. And I wanted to be at 1,000 doors last year. And it's just because of the lack of inventory, it slowed that progression. Not all bad, because it's allowed us to really make sure that the portfolio that we do have is operating as efficiently as possible. But with single family, there's also a lot more moving parts, right? For every house you buy, that house has a roof, it has a furnace, it has an air conditioning unit, it has its own hot water tank, its own plumbing, its own sewer line. So there's a lot more moving parts. And because of that, typically your costs are a little bit higher when it comes to scaling a single family portfolio.
Yeah, and I appreciate you sharing that challenge, because the lack of inventory is really real. That's what the entire real estate industry is talking about nowadays with the lack of inventory. But it's also for folks, I want them to be eyes wide open, because sometimes people will say like, oh, let me just go start a fund. I can raise capital. That's super easy. But then you don't understand that the risk that's involved when you have a preferred equity or preferred interest on your fund. As soon as you take in that capital, you start owing on that capital. So if 100%. You don't have inventory to deploy, you're sitting on that liability, and that continues to accrue. And I really 100%. Want to highlight this for people. It's like, hey, do you really want to go do this? Or do you want to work with someone that has developed the relationships and have the team in place that can scale this a little bit more easily? Because that's really the question you want to ask yourself. Am I willing to do the work that's required to scale this? Or might I just be better just investing with someone like Matt and riding his coattails?
Yeah, you're 100% right, Ken. The way I like to tell people is I say we're a private equity real estate investment firm, but when you break it down to it, we're actually like 4 different businesses within one, right? So we're a private equity group, fundraising capital group, right? We're a real estate investment firm, right? We're a property management group, so you have all these different businesses within the one business. And they're all these moving parts all the time. And everyone has to be operating as best as possible to make sure that the overall fund itself and the main company operates as efficiently as possible. That's tricky a lot of times, because everything kind of has to coincide with each other and kind of work in harmony, even though they're separate departments. Like my fundraising department, my investor relations individuals have nothing to do with property management. However, property management dictates to a point what our returns are going to be like, which our investors are getting. And so you have all these moving parts that constantly have to work in harmony. And if one kind of falls out of whack, that affects everything else. And so if my investor relations people aren't raising capital, then we can't go buy properties that we have under contract, which means we can't place tenants that we have on the wait list, which means we can't cash flow, which means we can't then return the returns to our investors that they're expecting. And so it's a lot of moving parts. It really, really is. And it's, people see the life that it can build from outside and like what we're able to do, but they don't understand the inner workings of it all.
I know.
And it's a lot.
I know that this engine that you have built is truly, it requires a lot of participation and a lot of teamwork to make this thing work. So maybe this is a good question for you. If you were to start your fund today, or maybe someone that wants to start a fund, do you have any recommendation on who might they hire first to join their team? Maybe there's 2 or 3 people or 2 or 3 jobs or roles that you think is absolutely crucial to kind of get the fund started?
I guess it really depends. That's a really tough question to answer, because it really depends on what that individual's background is. If that individual's background is from property management and they want to start a fund and raise money, then they need to find an investor relations rep or an individual that has experience raising capital from high net worth individuals. And so financial advisors, CPAs, accountants, stuff like that are always good people for that, because typically they have dealt with high net worth individuals, people that are accredited, people that are looking to invest, and they have that Rolodex, so to say, of contacts. However, if you are on the flip side, you have experience in capital raising and private equity, and you can raise the capital, but you don't know how to underwrite real estate and target specific cities that you can get good fair market rents on, as well as managing those properties once you have them in your portfolio, then you need to hire someone that has real estate investment or real estate management experience to be the one that handles that aspect of things. And you're going to learn all the roles as you grow, because if you don't learn all the roles, then you can't efficiently grow your company and scale it. But it's determined based off of what experience that person brings to the table.
And I love how you explain that, because this is what I tell everybody all the time. I tell them, focus on what gives you energy, because that's going to be the number one factor that makes you keep going, even on days that might be slow. Because for someone as an investor relations, there's still a grind. The grind is, quote,
100%.
You're calling 10, 15, 20 people a day. And most of the time, they might not result in anything at all, except just a friendship or a relationship that comes out of it. I know, because that's what I do every single day. I just talk to people. And I also underwrite deals. I'm really good at underwriting. So I only focus on investor relationships and underwriting. I don't try to get involved with, hey, for my development team, I don't get involved with picking the contractor. I don't get involved with deciding how deep the foundation needs to go, because that's not my job. For everyone listening out there, you have to pick your strength and find a team that's going to be complementary to your skills for you to scale this properly.
I love that you said that. There's a saying, jack of all trades, master of none, right? And if you try to do everything, you will never master anything. And so any true successful business person surrounds themselves with people that are good at the things they are not good at. Right. And that's what builds a successful business, because it complements what you're good at. Right. And they handle things that you're not good at. There's certain things I'm not good at. I'm not good at tenant relations and property management, mainly because I don't have the patience. My patience level is 0. And I know that. And so you don't want me talking to a tenant, because, I'm going to be direct to the point. They're going to think I'm being an asshole, excuse my language. And it just never goes over well. But I'm really good at networking and raising capital and underwriting deals and locking deals in. And that's why we've been able to scale, is because I can underwrite deals really well and I can raise the capital to fund those deals. And then from that point, the rest of the team takes over.
Yes, I love that. And maybe this is a good time to talk about, I always like to start with the end in mind. And I like to view you as someone that's operating at a very, very high level. Maybe you can share with the audience today, like, how is your team organized today? And what do you guys do in-house versus hire out? Because I know you mentioned you have a property management that you guys own yourself. So shed a little bit light on that.
So we have our corporate headquarters here in Pittsburgh, Pennsylvania, born and raised here. However, coincidentally, we own nothing in Pennsylvania, because we feel it's not a good state to invest in. But our investor relations is headquartered here. Our financial department's our accounting and financial department's headquartered here. Our property management company that we own is headquartered here inside of our corporate headquarters. And our acquisitions department is headquartered here as well. And that allows us to really operate efficiently. Now we do have a satellite office in Fort Lauderdale, Florida. And the only people in that office are institutional capital fundraisers that focus on raising institutional capital for primarily our multifamily division. We are opening up an office in Las Vegas, which will be our third office, because we have a lot of investors that are West Coast based. And the time change, or the time difference, is difficult to manage sometimes when you have investors that want to talk after they're done in the office, but that's 8 p.m. here, for us. And so we want a West Coast office that can cater to those West Coast investors, be on the same time zone, and be available for them when needed. And that's for both departments, affordable housing and multifamily. But majority of everything's still headquartered here in Pittsburgh. And, each department has its own role, has its own responsibilities. And then for me, from my standpoint, I'm kind of like the captain. I'm just kind of steering the ship from this 30,000 foot view. Right. And then with my executive team in place is managing, the department heads, and then the department heads are managing each individual department, and they're just kind of off and doing their thing.
Yeah, and I love that you guys have the property management group in-house too, because that's usually
It
a big
helps.
struggle for some people where they bleed
Yep.
money because it's too expensive, or they don't take ownership of
Yep. So
their own assets.
property management is one of those thorns in my side when it comes to real estate investing. And I've learned the hard way. I've had third-party property management groups handle stuff. We've handled it ourselves. I found the best mix of the both is owning your own property management group that you really control, that only manages your portfolio. There's a couple small investors that I know well that we take on third party assignments for their portfolio. But really, our property management group was built and created to only manage our real estate. Some of our multifamily is still managed by third party property management firms, mainly because the markets those are in, we don't have a big number of holdings in those markets. It's just easier to have a local company handle that. But for us, it's really important that we have our own property management group here. It's in-house. It allows us to react quicker to issues and maintenance requirements that pop up. And it allows us to communicate and get a handyman or a contractor or a plumber or an electrician out to that property quicker, get the issue fixed so that it doesn't turn into a bigger issue. And so property management's headquartered here, but in all the markets that we have real estate, we have our boots on the ground team, which is made up of, independent contractors that are handymen, real estate agents, general contractors, plumbers, electricians that we know we can call and rely on anytime we need to have something done based off of what needs to be fixed.
Thank you so much for going through that, because I think a lot of people, I met so many people that are in affordable housing, and sometimes I've had some folks that used to be on the Bigger Pockets podcast, and they would talk about how the only way for you to screen the best tenants is sometimes you just have to go to their current home and see the condition of their home and see how well kept it is, because sometimes how to
Right.
keep the current home might be how they treat your home, but that
It can
seems to
be.
be almost unscalable, right? But you
It
have
is.
found a
It's
way.
it's it's 100% unscalable. Yeah, I mean it is. And is there more risk with the way that we do it versus not going to someone's current home? Sure, but at the same time, I'm never going to ask any of our tenants in our multifamily for us to go look at their previous unit that they lived in to see what it was like. I'm gonna look at their background. I'm gonna look at their criminal history. I'm gonna look at their credit history. I'm gonna look at and see if they have any evictions. That's gonna tell me how they take care of their life. Because if there's anything on any of those that look to be a mess, well, then their life's a mess. And we don't want them, not just in our affordable housing portfolio, we're not going to place them in our multifamily either. So, as long as you're underwriting the tenant properly, you don't have to worry about going in person, physically seeing their current house that they're living in, seeing the condition that it's in. There's other ways to kind of really figure out if they're going to be a good tenant or not. And look, anyone can be fooled. You know what I mean? If someone knows you're coming to tour their current house to see the condition of it, you can't tell me they're not going to do everything they can to get that house cleaned up and looking the best that they possibly can because they know you're coming. So, it's like,
Exactly.
come on. The other thing that we do is we do quarterly inspections on every single property we own. So we are doing quarterly walkthroughs and inspections, spot inspections, 24 hours notice based off of our leases. And we're showing up, doing walkthroughs. Our contractors are doing walkthroughs, videoing them, sending them back to us. And that really helps to keep properties in really good condition because tenants never know when that's going to happen and they don't get enough notice that allows them to really clean up any major mess if they've created it. If they made a mess of the property, 24 hours isn't enough notice for them to fix it. And so we see that when we do the quarterly inspections. And honestly, we haven't had really any issues with any tenants since we've implemented those quarterly inspections. Everything's been in really good condition.
Wow. I'm so glad you brought that up, because that's not something a lot of people do, because it sounds like a lot of work, but you
It
do it
is.
because it creates results for all of you.
Right.
Wow.
The better condition you can keep your property in, the more profitable you're going to be because you're not having to fix things all the time, or you're not having to go in and do a complete turn on that property whenever that tenant moves out. And so that means that you're more profitable. That means that you're cash flowing more on that property every single month. And that's important, especially when you have to answer to investors.
Man. And I think this is such a good point to highlight, because there's so many people that sometimes when they underwrite deals, they don't underwrite with maintenance. They don't underwrite with
Mhm.
vacancy. And it's so wrong and it's so unbelievable. It defies common sense sometimes, but sometimes people just don't do it because sometimes they just don't know what they don't know. So maybe you can share
Right.
some, like, how do you guys
Yep.
decide what's a deal, and how do you guys underwrite assumptions like expenses and vacancy based on how your portfolio has performed?
So it's funny you mentioned the vacancy thing, because I always hear the argument, well, it's a single family home. I'll be able to find a tenant for it. I'm like, yeah, but how long is that going to take you? Every day it takes you to find that tenant means that property is vacant, which means you're not making money on it, but you're spending money on it. I can guarantee you that. What happens when they move out and you have to turn that unit? It's going to be vacant when you turn it, and when you market for a new tenant, and when you have to place a new tenant, even if you're proactive about marketing ahead of time. And so those things all matter. I mean, and you have to look at, when you're underwriting property. So we factor in pretty much an 8% vacancy, an 8% maintenance reserve into every underwriting report that we do. And then as far as identifying criteria for properties, we have a buy box, and our buy box is very, very simple. It's $85,000 to $105,000. It needs to be a 3-bedroom single family home or more in a market that we can get at least $1,350 to $1,400 in rent on, so that we can cash flow on average about $600 net per door per month. Really, really simple what our formula is, and it works really, really well. Now,
And
with
that's
that,
net, including
that's
expenses and
net.
maintenance. Okay.
Everything. Yeah. Net.
Great.
That's after debt and everything. And when rates got up to that 9% range, it got really, really hard to hit those numbers. But we knew that we might be a little bit short that first year. We might only be netting 525, 550. But we know when we request a rent increase, it's going to get us over that threshold that we need to be at. And so the one thing is with real estate, it's a long-term game. It's a get rich for sure game, not a get rich quick game. Right? Because if you do it long enough and you do it right, you will get very wealthy off of it, but it's a long-term play. And so making sure that you're underwriting a deal up front, making sure that you have those expenses included in there, making sure that you're factoring in the vacancies, the time it takes for the housing authority to process that application, to get the inspection scheduled, to get the inspector in there and get it approved. That's vacancy. And so you have to incorporate that in there. There's going to be maintenance. A lot of these are single family homes, and single family homes have maintenance to them. And especially in a lot of these homes that are older, you run into a lot of sewer issues, sewer line issues. You need to replace sewer lines. And so being proactive about that during due diligence when you're buying the property and making sure you're doing inspections, making sure you're doing sewer scopes. Yes, it costs you money up front. That's an acquisition cost, but it's going to save you $8,000, $10,000, $12,000 down the road of expenses that are going to eat your profits away for a couple of years if you have to spend it.
Got it. And I noticed you said $600 net. Is that do you guys also understand or calculate like how much money you have to spend renovating the property, get it up? Like, is there a maximum threshold that you guys will say, hey, we will not spend over this amount of money for rehab?
Yeah, so basically, we don't want to spend more than $2,500 to $3,000 on a property once we close on it to get it, to inspection, ready level. So we pretty much buy things that are move-in ready. We love the older homes that, grandma has kept, for the last 50 years that might be outdated, but it's in really good condition because she kept it up. And those are easy to rent too in the program and with the housing choice voucher program. But we like newly renovated properties too. So we like to buy a lot of properties from fix and flippers that we know and we trust and do good work. Now there's a lot out there that do not do good work, and they cheap it out and they skimp on a lot of stuff. So you have to be careful of that. But we like to buy move-in ready properties where, maybe we have to go in and put some screens in the windows. Maybe we have to go in and put some railings on steps, fix some outlets, some non-grounded outlets, things like that, it only costs us a few $1,000s. Anything above that, it's really too much expense. Unless we can get a really good discount on the property, it's just too much expense for us to do. We also coincidentally request the sellers provide appliances so that we don't even have to worry about going to buy appliances.
Genius. I love your strategy, because sometimes there's folks that talks about the BRRRR strategy. Like, okay, I gotta go find a really run down home so I can put enough value, and they don't understand how long it takes to pull permits.
Right, exactly. So our goal is to cash flow on every property we buy within 30 days. So every property we put under contract, when we're going through due diligence, we start marketing that property to get a tenant for that property. So the day that we close, we already have a tenant for that property. The RAFTA packet's already filled out. It gets sent into the housing authority, and then we're just waiting at that point. The contractors are doing the little fixes that need to be fixed because we've already had the list of things that need to be done before closing. We already know what's going to cost. They're doing all that while that packet's being processed by the housing authority. So we're literally waiting for the rent offer to come via email and then schedule inspection. So that allows us to really get cash flowing really, really quickly. Now, sometimes the housing authorities are slow, but that's the target, is 30 days or less to cash flow on every single property that we buy. And we are really, really good about hitting that, especially when we buy heavily in 3 markets and the housing authorities know us and they know that we take care of the properties. They know that most of the time we're going to pass inspection on the first try, and they see our name on the packet and they're like, oh, we're going to push this through quicker, because they know how we work and they like working with us.
And folks, that's efficiency, guys. You don't just come into a market and start doing that on day one and being able to cash for 30 days unless you have those relations with contractors and the housing authority.
Yep.
100%. Wow, that's really, really impressive, Matt. Maybe this is a good time to ask you about, you have a huge team and they have done really, really well for you. In terms of like your acquisitions team, because the point of why I'm asking these questions is I want them to understand how hard it is to build a team to get to the level of efficiency that you're getting to. So maybe let's just take acquisitions and property manager. Like, what sort of traits or personalities or characteristics that are you looking for whenever you're hiring acquisitions folks?
So for me, from the acquisition side, is I want someone that's extremely proactive. I want a self-starter. I want someone that isn't just looking to pick things off the MLS, right? I want them to be prospecting off market. I want them to be prospecting, motivated seller lists, stuff like that. So someone that understands sales, understands how to network, understands how to do outbound marketing and cold calling, and isn't afraid to do that. So that's really, really important. And that's hard to find. I have found that for this portfolio and that specific position, real estate agents that have been successful and understand how to generate listings really do a good job in that role, because they're okay with cold calling, they're okay with door knocking, they're okay with being told no, they understand real estate, they understand how to value real estate, and that's really important. Those characteristics is what I look for when it comes to the acquisition side. From property management side, I actually want someone that is extremely patient, that understands the asset class, understands the types of individuals that we're working with, and is good at working through problems. Like, problem solving is really important when it comes to property management with this asset class, which I will say most third-party property managers do not do well. They don't know Section 8, they don't know affordable housing, they don't understand the housing authorities, and they're not patient people and they don't have buy-in because they don't own the real estate. They're simply there just collecting a paycheck. Right. And so they don't have your best interest at heart as far as an investor goes because of that. So, from the property management standpoint, it's, very almost empathetic to a point, but understanding problem solving and kind of helping work through to find a solution.
Yeah, I love you said that. It sounds like your team has a lot of compassion for your residents. At the same time, they're also really
property management. Yeah.
I mean, are they also responsible for your renovations at the same time too? Your property management.
We have a project manager within property management that handles the renovations and the projects that need to be done. Dealing with the handyman, the contractors, etc. So if anything needs done, he's the one that takes over at that point, finishes it, and then property management confirms that it's all done and good to go.
I love that. Maybe this is just more of a leadership question then. How do you keep everybody motivated and incentivized? This is a really good question, because sometimes, affordable housing is doing a good thing, but it still comes with establishing a great culture to work with.
It does. So for me, I'm a pay for performance type of person. It's just how I've always been in my life. I'll be honest, I'm money motivated, right? And it's important to me. And so I like to incentivize all my employees. Doesn't matter what position they're in. I like to incentivize them with bonus levels and, ways that they can increase their income by hitting certain things. And so with property management, we have occupancy rate bonus levels. Once they hit certain occupancy rates, we have cash flow bonuses, meaning if they can, for every property that they get cash flowing in 30 days or less, they get a flat bonus. Project management is part of that as well, because they have a direct role in making sure the property is ready to go and be inspected. And so they have a bonus for passing inspection on the first inspection. Acquisitions has a bonus based off of the number of properties that we actually close on every single month. Investor relations has bonuses based off of the amount of dollars they raise and exceeding the goals that are set. And so everyone is incentivized money-wise, which is one way to motivate people. The other way is it's a very yes, we're structured. Yes, I expect results, but it's a very loose kind of working environment. We like to joke around. We like to have fun. We do team building, retreats where I'll take them out to like Top Golf and we'll have a good old time, blow off some steam, or I'll take them to dinner. We'll go grab sushi. Letting them know that you appreciate their hard work goes a long, long way. And I think that's what a lot of people don't realize is that just letting someone know, hey, you did a good job. I really appreciate that. I noticed it. That goes a long way by itself. And so just a good working, fun working environment is really important as well.
Yeah. And I love how you set up your structures. And man, this was almost like a $100,000 mastermind with millions of values. Because guys, this is learning how to create a structure that can make a team operate at a high level, but also make sure that everybody's still enjoying the time they're having with each other. And that's so important because why do we do this? We did this to hang out with people that we really love and enjoy being around. And then we're all there to help people together.
I mean, the people you work with, you're with them more than you are your own family most of the time, right? And so it has to be a fun, good working environment. Don't get me wrong. I mean, we've had growing pains as we scaled with, hiring the wrong people that, said that they could do the job, that they weren't able to do the job, people that were toxic and just, really brought the environment down, and people could feel that and didn't like the vibe. Everyone goes through that, but it's about, as I like to say, hire slow, fire fast. You need to cut that stuff out of your organization as quickly as you possibly can when you realize it's going on, so that because otherwise it's just going to kind of like fester and grow. And then it affects everyone. And people don't want to come to the office. They don't want to come to work. They don't like being around that person. And you can feel that. I mean, you can definitely feel that type of energy. And so I get rid of those people as quickly as you can.
Thank you so much for elaborating on that. Because I think it makes people I think you have pulled back the curtains a lot today, Matt, on what it means to run a fund. And more importantly, you demystified the process a little bit for folks that says, hey, if I want to do this, this is really what it entails. It entails hiring. You have to get a little uncomfortable. You have to find other people to be part of your team. It's so much work. So really decide if you are really in it for the right reasons. And then maybe reach out to Matt for some mentorship.
Well, so here's the thing. This is what I tell everyone. And I get people asking me all the time. I don't sell courses. I don't sell masterminds. I don't sell mentorship programs. I don't do any of that. Like, I'm not one of those gurus, so to say. And you know who I'm talking about, Ken. I mean, they're all over the place, right? I'm not that person, because it goes back to my patience level, right? I don't have the patience for that. Even though I know I can make money doing it, I just don't have the patience for it. And if I'm going to take someone's money, I want to make sure that I'm giving them not only what they expect, but exceeding those expectations. And I know if I did that, I would get so frustrated that it wouldn't be good for anyone. And so I just don't do it. It's not that I won't give people advice. I'll happily give people advice. It's one of the reasons why I come on podcasts like this, is so I can kind of open those doors and let people know and give some tips and advice and stuff like that. But you will not find me selling courses. You will not find me selling mentorships. You will not find me selling masterminds. Every once in a while, I'll get hired to go do a speaking engagement, but that's as far as I go, guys. So sorry, but not sorry.
Man, Matt, I can't tell you. Sometimes people ask me for coaching or one-on-one stuff as well. And I'm like, I'd rather not. Because this is right. If everyone says information is all you need to have a six-pack and be a billionaire, everybody would be it. Right.
Exactly.
That's not the case. Exactly. Matt shared so many secrets with all of you today. And you can pretty much say, like, okay, this is what it takes. But we all understand how hard it is to hire the right people, to find the right people. You got to put yourself out there. These are all uncomfortable things that you have to put yourself through. So
it takes money too. And it takes time. And if you don't have the money, then there's not really much you can do. And so it takes time to get to the point a lot of times where you have the money to hire those people. It's not something that happens overnight. You know what I mean? Like, as I say, my overnight success was 20 years, a broken back, a broken pelvis, and one divorce. That was my overnight success. Because there's no such thing as overnight success. And we're still not where I want to be at. I want to be at $1 billion by 2026. And then we're going to go to 2, and then we're going to go to 5. And, ideally get to the point where we have 10, so we're in our infancy, man.
And I love that. I love that we get to be part of your journey, man. And it's going to be so cool to continue watching your journey. Maybe I'll ask you one more question, because this is a question I ask every single guest on that comes on the podcast. Why do you think affordable housing, particularly the lack of supply of affordable housing, is so hard to solve for?
Ooh, I think the biggest, I think it goes back to education, to be honest, because it's a very misunderstood asset class. We talked about it a little bit earlier, right? We hinted on it. It's a very misunderstood asset class. And I think that happens because there's not a ton of education out there on it. There's not a ton of people talking about it. And when you don't have people talking about it and education not readily available, people take those rumors and they run with them. And so they immediately think, ooh, I don't want to be investing in that asset class. There's way too much risk. I don't make enough money. It's low income. It's low rent numbers. So I just think it's a lot of, I hate the term misinformation, especially over the last couple of years, because it's been so overused. But I just think there's not enough valid, real information on the program, on the asset class, to entice people to want to place their properties into it. I think education on this asset class and how to do it right would go a long way in solving the inventory issue that this asset class has and the lack of inventory. The problem is there's no one doing it. Or I think about the ones that are doing it are charging ridiculous amounts of money to teach because they're only worried about lining their pockets.
And Matt, this is why I'm so happy you came onto the podcast, man. First of all, I want to thank you for what you do, man, and what your team does, because without people like you and your team, man, I would have never had the home I grew up in. So for that,
I remember you telling me that.
So grateful. I'm so grateful. And I don't know if I shared my story with you before, but my parents they're first generation immigrants, and my dad came over with $1,000 in his pocket, and my mom had made like $3 an hour in her first job, and they lived in a 2-bedroom home with 9 people. One night, my mom had $5,000 of cash out, and she was getting ready to bring that home to China to repay some of her relatives. That night, someone came in and robbed them, and I don't know if you can imagine losing an entire year's salary in one night, but that's what happened to them. But she told me, the life lesson here is that, hey, bad things happen to good people, but it's about how you bounce back that matters, just like how you did from your tragedy. And she said the only thing that kept her going was that she had hope, and the hope came from being on a wait list for affordable housing. So that's why I'm on a mission now to create the largest affordable housing investment community in the United States.
I love it. Because
every single person I put in one of these homes is helping someone just like my mom. And you are a big part of it. And I'm so grateful that you came on today to share your wisdom and your tips and tricks with the audience today, man. Like, this is how we solve this problem, by putting out education like this on this podcast.
I agree. And so that's my pleasure. I was excited and I'm happy to be on here. And I also want to extend something else to you and let you know that anything you need in the future to help educate, teach, whatever it is, just consider me in on it. Will absolutely happily do it at no cost to help out your mission and to help educate others on this asset class and how it can be beneficial from so many standpoints to so many different people.
Man, I'm so glad I brought you on, because at least I know how you underwrite, because we know some of these gurus out there teach people to underwrite with no maintenance and no expenses. And I'm just like, what are you doing? You're leading people down the wrong path.
That's why they're not. They're furus, man. They're fake gurus because they don't even know what they're talking about, right? They don't make. But what I love is those people. Most of them are making more money off their coaching than they are off the real estate that they say that they're invested in, and that by itself is a huge red flag.
Absolutely, man. So, Matt, I know this is on your website, but if people want to send you and your team deals, what markets are you guys looking for deals in right now?
Yeah, so when it comes to our affordable housing, the 3 markets that we're heavy in is Cleveland, Ohio, Mobile, Alabama, and Birmingham, Alabama. We pulled out of 2 other markets, which were Detroit and Memphis, because we just didn't like the housing authorities in those markets. They were just not easy to work with. And then the underlying infrastructure was extremely old and dated, which had a lot more maintenance costs to it. So those are the 3 markets that we're currently in for the affordable housing. As far as multifamily, anything across the Sun Belt and Midwest, we are heavy buyers in. So North Carolina, South Carolina, Georgia. We'll look at stuff in Florida, but Florida is very inflated right now. But we'll look at Texas, but Oklahoma, Tennessee, those markets are all markets that we're buying heavy in when it comes to the multifamily space.
Got it. And for your multifamily deals, what type of asset unit count and like
typically we want a Yeah, typically we'll want a minimum of 100 doors. So 100 unit multifamily. We will look at some smaller if they're in Florida. We'll go down to 50 doors in Florida. Class B or C plus we'll look at, but there needs to be value add. There has to be good meat on the bones for us to, that's our business model, is heavy value add. We're buying a property in Georgia right now. It's 134 units, class B minus property, but it's 21% occupancy and 94 of the units need to be renovated. But we're paying 10 million for it, and it's going to be valued at 19 million once we stabilize it at 90% occupancy. So those are the types of deals that we want because that's our bread and butter, and we hit home runs with those all day long.
Let's go. I'm so excited for you guys on those deals, man. Hey, so if people want to reach out to you or find out more about you and your company, where should they reach out to you and find out more information about you guys?
Two different places. You can go right to our website at simcapital.com, and everything as far as what we invest in, what funds we have open, what the investment criteria is all there. Also follow me on social media, primarily Instagram. It's real Matt Simmons. Just remember my first name is only spelled with one T, so it's real MATSIMMONS. And you can find me there and shoot me a DM. I try to be really good with following up with DMs that go into my kind of spam or hidden folder. But if you don't get a response from me within a couple of days, just post a comment on one of my posts and I'll see that and make sure I hop in that folder and respond to you guys. So yeah, but I'm happy to answer any questions people have. Don't hesitate to reach out. Don't hesitate to shoot me a message, guys. I am here to help.
All right, Matt, this has been an absolute wonderful conversation with so much value packed into it. I was just thinking in my head, maybe I should have some of your team members come on to talk about, their daily jobs and the problems that they face, because that would be really cool to kind of pop open the hood and really show people.
I'd be happy. They are not as outgoing as me when it comes to being on camera and stuff like that, but I know a couple of them probably would, so I'm happy to make that introduction and connection, and you guys can take it from there for sure.
I love that, man. Hey, Matt, thank you so much for coming on. And I can't wait to have you back on the podcast in a year from now as you get closer and closer to that $1 billion mark, man.
Yes, sir.